Yes.
I do.
Hi guys. So welcome to Service First Mortgage. This is our in beautiful McKinney, Texas. Hope you guys had a great morning so far. This morning, this is our headquarters office, where all our CEOs and everything are, and this is where all the magic happens. Now my team is actually in Fort Worth, Texas. I've been a loan officer for almost 20 years now, here in the North Texas area, and I'm at Chapel Hill Boulevard, as you can see. I've been with this group several years. This is the builder division, one of the builder group offices for Service First Mortgage, and we have about 40 preferred builders that we work with. I heard somebody say you're Juliet earlier. We're West Side.
Nothing negative.
Yeah. You know, right now they have the land, you know, so that's positive, right?
I was gonna say, they're about the only ones with inventory right now.
There's a few, there's a few,
That's why.
there's a few. But yeah, we're all keeping tabs on that, but yeah, so, we do work with D.R. Horton West Division, 35 splits them. There's east and west, and we're on the west side. So anything to the west, we can give incentives and use our approvals for. But yeah, so that's a little bit about me.
You're the
guys.
preferred lender for D.R. Horton?
What's that?
You're the preferred lender for D.R. Horton?
No, we're the only one other than DHI, Service First. Yeah.
Okay.
So, but not east side, just west. Just let you know.
So how do you compare to their incentives for the buyer? Like, I know DHI will give them title policy.
On the west side, you're gonna get everything plus incentives from us. So you're gonna get the whole kit and caboodle. Yes, sir. Well, more, actually, because we give a lender credit on top of that. On the east side, man, they're doing some deals right now. I like 6,000-7,000 in incentives, you know,
Yeah.
to go with them. So that's, just being honest, that's tough, you know.
Right.
So guys, welcome to the CE today. Today's CE is called Real Estate Tax Stories Part 2. And this is part of a 10-part series on financial and real estate storytelling. Each of the 10 parts is available as a standalone course, and it's approved for continuing education credits in over 20 states. The courses are also approved for CPA and Certified Financial Planner continuing education in all 50 states. And basically the goal of this 10-part series is to help you use the power of financial and real estate expertise to benefit your clients and also help you strategically grow your business. So this is a hot topic right now, and I know that in the appointments I've been in this week, it comes up just about every time right now. And that's just because we have so much equity in our market. And we're gonna run through some examples today, show you guys kind of how this all works, so that when you're talking to your clients, if they have questions, we can be knowledgeable and objective about that information. Hopefully we can encourage them and also just kind of help them with some of those concerns that they might have. So the objectives of the course, there's really 5 today. We're gonna discuss some things that aren't 100% common knowledge, just so that you guys are really kind of up to date on what's going on with these taxes. So how does the tax basis work and why it matters? That's the first thing we're gonna talk about today. How to better understand and also better use the principal residence exclusion to the capital gains tax. Then of course we want to talk about the 3.8% investment income tax and how that works. We're also going to look at some examples of the capital gains tax and how that works. Lastly, we're going to take a little bit of a dive into some information about rental income, depreciation, capital gains, and capital losses on investment properties. And then we're also gonna dig into some information about 1031 exchanges. You guys familiar with that stuff?
Yes, sir.
Awesome, good deal. So for our clients, there's really 4 areas of taxation that affect our real estate investments and their activities. There's income tax. We have capital gains. Of course, income tax would be, you know, your job, etc. Capital gains, the sale of property. We have gift tax, which is me, let's say, giving Vaughn a property, you know, during my lifetime. And then there's estate tax. I pass away and I leave my property to Vaughn as my heir.
Is capital gains only property or real estate?
capital gains. There is, capital gains on other investments, but today we're just gonna cover, the real estate. So that's why it's important to be trusted advisors, to understand the tax impact for our clients today. And we're gonna focus on the capital gains piece because, like I say, in the appointments I've been to this week, that's really what everybody's considering. So when we're thinking about our role as a real estate financial advisor, it really is important to think about, this question: are my clients gonna be better or worse off because of my advice? The reason I say that is because, and this is my disclaimer for the course, guys, I'm not a CPA. I don't know if any of you guys are. If you are, that's great. You can talk specifics to your clients about taxes all day long. For us that are not CPAs, we just want to be informed and know what's going on, but definitely discuss with your clients, but just steer clear of any specific tax advice, because that will potentially get you in trouble, and we don't want that. So you're gonna hear that a couple times from me today. So let's start today with the tax basis and how that affects capital gains, because a lot of people don't know that there is a basis that capital gain is calculated off of. For you guys, a capital gain for our purposes today is really just equity. Your profit from buying a property really is the capital gain. So let's say in this example, I bought a property for $200,000, okay? And there was a 5% or $5,000 closing costs on that property. And then during the life of the owning the property, I fixed up the bathrooms, I renovated the kitchen, and it was about $45,000. So my tax basis for the property, it's the cost of purchasing, building, or improving the property, is $250,000, okay? My price, closing costs, plus any improvements. Okay, so I contact Benjamin, and I'm like, Benjamin, I want to sell my property. I'd like to kind of get $450, Benjamin says, I got this, does some great marketing, negotiates the heck out of it, gets me $500,000 for the property. I'm super happy. I take my tax basis off of that, which is my cost, right? And that gives you your capital gain. So it's not the full amount.
Is it the cost from the beginning of?
It is.
When you have your?
Yes, the original purchase
If
price.
you had it for 15 years or something, you could.
Yes, ma'am. You keep that cost, the closing cost, that's purchase and sale, and then the improvements while you own the property.
Okay.
I have a question about the improvement part.
Yes, sir.
So if you own it for 15 years, you replace the faucets in the bathroom. So you gotta obviously keep all your receipts and have an accounting of the improvements themselves. But what about depreciation on the improvements?
We're gonna get to that. Awesome. I like it, Jared. But yeah, the improvements, you should have that stuff from your tax records. If you own the property, believe me, you'll keep track of it, expenses. But we will get to depreciation a little bit. So in most cases, the capital gains tax is 15%. That's kind of long-term capital gains. That's for most people, okay? With that $250,000 capital gain at 15%, you can see that my taxes due are about $37,500 on that particular transaction. Now let's talk about the capital gain for just a moment. The current capital gains tax rates, there's really three brackets. There's a 0% capital gain, and if you're in the 10 to 12% tax bracket, you can actually sell and you have no capital gains tax in any circumstance. So that's pretty huge. Most of us are going to be in this 15%, 22, 24, 32, 35% tax bracket. Then we've got our higher earners, some of our clients that have big W-2s or big bottom line taxable income, and that's 20%. And let me show you the numbers for just real quick. Oopsie, hold on just.
Numbers are based on investment property, not personal residence.
Right.
Let's see here. Here we go. So here's the gains, the rates for this year. So you can see, single filers up to 41,675, there's no gain, and then married up to 83,350. So if I'm gonna sell substantial real estate this year,
You should get married
Bless
first.
appreciate it. Did that already.
Well, I did that
But that's
too.
not bad.
I
like
mean,
it.
that's how I avoided some stuff.
It's a good way to do it, but either, you know, get married, as Juliet said. Or you, if you're under that 83,000 that year, like you expect, hey, I'm not gonna have much income this year, that might be a good year to sell something, you know? So, just to keep that in mind. Now, look at that 15% is 83,351 to 517,200. And
Where
then,
did you get this?
you're bigger.
Where is that
This is
one?
just from the IRS.
Oh,
Yeah, this is info from the
Is this
IRS.
nationwide?
It is, yes. Now, I'm not talking about any state taxes here, guys, this is federal, sorry.
Okay.
If there was any questions, so. But yeah, just so you can get an
So
idea.
either be poor or married,
Well,
or you sell.
I mean, these days, combined household, like you say, most people that are normal W-2 are gonna fall in that 15%, you know?
Isn't there some kind of exemptions to, like, you're allowed to do it one time in your life, you can sell in?
We are gonna talk about that.
Okay.
Yeah.
Is
Yes,
that,
ma'am.
thank you, does that go along with, because this is a good thought, the principal residence, right?
We are about to talk about that. This is for everything. Yeah, this is for all capital gains. This is just the tax rates, and we're gonna go over a few
But-
examples.
Right, but for instance, in just regular single-family residence sale, it would not apply, none of this would apply if it's your personal residence.
Just depends. It depends, and I'll show you what the difference is.
All right.
Yeah. Let's take a look-see. Okay. So really, guys, before we get into that, Tom, I
Do you
love
want us
where
to
you're
ask
at,
questions
man.
along the way?
Yeah, that's fine.
Okay, sorry, I don't
Definitely.
wanna interrupt you.
No, you're fine. It's just us, guys.
Okay.
Fire away. I'm happy to answer your questions. So, if we have a capital gain on our property, there's really only three things that we can do at that point. A capital gain is, you know, we made a bunch of money on it. I'm sitting on my property and I've got all this equity, so I can either sell the property right now and I can pay a capital gains tax. Unless, of course, I'm exempt from it. I can gift the property, you know, to Jerry during my lifetime. You're welcome, sir. Or I can keep it and I could pass it on to Tom when I pass away, okay? And so let's look at what happens to the capital gains in these types of situations, okay? So again, remember, Benjamin really kicked some butt on the marketing and he negotiated me way more than I thought at $500,000. I'm really, really happy about that. Remember earlier, I had a tax basis of 250,000, right? My capital gain on this then is 250,000, because it's the sale of the property minus the basis. So that basis is really important for what your customers are thinking about on what they're gonna do with their property for our conversations. Now, I can gift the property, to Jerry, right? And if I gift the property to Jerry while I'm still alive, then Jerry is gonna get a carryover basis for my,
Oh, you're
taxes.
giving him your tax.
Oh, excuse me, hold on, sorry, y'all.
Can I get this right?
Sorry.
Yeah.
Okay, so he's gonna get that carryover basis, so your capital gain, Jerry, would be the same as mine, if I give you the property, right?
Both,
What's that?
both would be,
The basis, yes, he gets my basis.
okay.
Yeah,
It's a gift.
if it's a gift, then he has what's called a carryover basis.
Okay.
So all those expenses I had that are deducted from the capital gain, I give it to Jerry at that point. So he only has a capital gain, instead of $500,000, he only has 250.
Are there standard deductions, like if you give it to him and you don't give him receipts?
You know, that's a CPA deal, as far as the gifting on
Oh,
that
okay,
side.
sorry.
You gotta pass the receipts along with it too. You
I'm
guys
just
approve.
saying.
Yeah. Now, as far as.
Sorry.
Probably
No,
not the
you-
same year, but if you get audited, I would assume, does that sound right? I mean, I'm gonna send in my receipts for improvements that year, but if I get audited, I better have them.
That's a good point.
Does that sound right?
I wonder if there's like a 7-year deal anytime, 7 years, think about that.
Oh, I doubt it. But that's just me. I bet it's a 20-year period. But to-
Okay.
So let's move on to the inheritance piece. So if I gift my property upon my death, okay, this is a big deal. Hey, good morning.
Come on in.
Come on in. You wanna register so you can get your hours? Yeah. So if I give my property to my heirs, let's say, they actually receive a step up in basis, okay? This is pretty important. So what is the step up in basis? Is the value of the property at the time of my death, okay? So Benjamin sold my
What?
property. Yes, ma'am. So Benjamin sold my property
Tell
for
my
half
mother
a
to give
million.
me the house now, right?
Exactly. So if the property is worth $500,000 or $1 million or what have you, and I give it to Vaughn and I pass away, upon my death rather, she inherits the property. She gets, the tax basis is based on the value of the property at the time of my death. So Vaughn, if you pay that, if you basically sell the property right then, no taxes back here for your heirs.
Okay, so repeat that again, please.
Okay, so if I
So
pass
when you
away,
pass away, you,
I give you
Okay.
my property, you're my heir, right?
okay,
In the will,
In the will, yes.
okay,
And so the property at the time of my death is worth $500,000.
okay.
when you die,
When I die, it's worth $500,000.
give it to her.
You
When you bought
inherit.
it for 150,
Well, it doesn't even matter.
Doesn't
oh,
matter.
really?
Does not
Okay.
matter. No, ma'am, because you
Oh.
received the stepped up basis from my asset.
I see.
So it's beneficial to pass it along in your death as opposed to current because you pay less taxes on
It could
Well,
be.
you do, but you're giving your taxes higher to your kids.
No, they're getting, if they sell it that year, there's no capital gain in that.
Okay,
So
so,
it's the
But there's no
$500,000
capital gain plan?
$5,000.
That's a good deal.
If I sell my property, I'm sorry, what's your name?
Michelle.
Michelle, hey, I'm Luke. So Benjamin sold my property for $500,000, okay? And there was a couple of examples we were looking at. In this case, this was me giving the property to my heir.
So you're still alive.
I'm
No.
dead. I died.
dead.
I died
In the
and I
will.
gave the property to
Okay, in the
Vaughn.
will.
In the
Okay.
will, I gave the property to Vaughn.
and I sold it to him,
For
the
500
same year.
For $500,000.
What if I sold it for more?
Then you would pay a gain on.
Let's
Okay.
say
above the-
550.
Above the
then-
basis.
Then I have to pay tax on the 50K.
Unless-
Your basis is what the value is when I die.
Got it,
So if you sell it for a little more, then you would pay capital gains on the excess.
got it.
Unless you can exempt it, right?
Correct.
From
Unless
the
you
next
can
slide.
Yeah, we're getting.
Unless what?
Right, so if you're
Tom's
dead-
jumping ahead.
No, that's just important because
It
our
is.
clients wouldn't care about any of this if they're not paying it. They'll
That's
just say,
it.
okay, I'm not paying it.
I'm
You know
not
what I
paying
mean? That's all. But I love to hear the backstory of it.
Yeah, so if I gift it, let's say I gift it to Jerry, then he's gonna inherit my tax basis of $250. So Jerry, you are gonna pay some capital gains if you sell it.
Right.
But if I pass away and I give it to Vaughn, she could potentially sell and not have any capital gain. So today, we're gonna be looking at a lot of long-term investment strategy and how it pays off. This is just the way the IRS code is set up, so.
That's a great one, the inheritance.
Pretty cool, huh?
Even if you only have one, right? Give it to your kids or something and let them.
Yes, sir.
Great.
So hopefully this will help you guys when you talk to your clients about it.
Yeah.
We're about to get into some good stuff, man. We're about to get into some really good stuff. The principal residence exclusion, and I went on a few listing appointments this week, and I'll tell you about those later. But those appointments, this came up just about in every single one, okay? Awesome thing about the principal residence exclusion is that it is $500,000 for married couples filing jointly. And then it is $500,000 for a widow or widower who sells the property within 2 years of the spouse's death. So if I pass away, my wife sells the property within 2 years, she then gets that $500,000. Now, if she waits past the 2 years, it does drop down to $250 for.
Unless she gets married to someone
Unless she
else.
marries someone
Then
else.
it's 500?
Juliet's thinking.
Would it be 500?
And we go back up to 500, yes.
Cool.
That's right, so yeah, maybe a good idea to get married that year.
Or, yeah, we're just on paper.
On paper, right, on paper. And so married couples filing separately, right, they each get the $250, so that adds up to $500. There's really only a couple things I want you to understand about this for right now. You have to live in the property, right, for 2 out of the last 5 years. Or you guys all probably know this stuff, right?
Mhm.
You talk about it with your clients. Now, the important thing that I think is really exciting is that basically you do not have to apply those proceeds to another sale. You know, back in the day, you did have to roll it over. Now, that $500,000 can go right in your pocket, no taxes, on your primary residence.
So you lease,
What's that?
so you just lease
Well, I guess so.
and put that money in the bank,
Buy
it in the
or
bank.
put it in Mexico
Buy it.
bank.
Buy Bitcoin or yes.
Yeah.
Yes, exactly.
Oh, so it's, can you read that other one about the widows? I actually have a widow seller right
Yes.
now.
If she is within 2 years of her spouse's death, she can claim that full
It is,
exclusion.
but that's also the basis though, right? Like,
Oh.
she's gonna sell for approximately 800, and she bought for 500.
I love you, Tom. We're gonna get to that in just a second.
Okay.
You're making my job so easy.
Just widowed,
Thank you.
surely.
So you can use this exclusion every 2 years, okay? Every 2 years, there's no limit. And of course, our customers are gonna ask us, can I use this on my second home? It does not apply to second homes or vacation homes. It's strictly just the primary residence.
Or
case.
rentals.
Or rentals, right?
Yeah,
No,
rentals.
not investment.
No.
Yeah.
So this is just principal.
Yes, ma'am.
Oh.
It is just the principal residence exclusion.
Got it.
So, let's get to your example there, Tom.
Surely.
Let's get to the good stuff. So, in this case, the principal residence exclusion is gonna save this customer $75,000 because they're selling at a 1 million sales price. Let's say I contact Michelle, say, Michelle, I've got this property I wanna sell. I'm thinking, 925. She says, great, I'm all over it. She markets it, negotiates it amazing, and I get $1 million. I'm super happy, okay? And this is kind of, becoming pretty typical for our market, right?
Yes.
This is the kind of price point we're in. Now, in this house, you guys, I really didn't pay that much for it, and I haven't put much into it. I've only got a $250K basis. Basis is basically the cost of the home, the closing cost, and the improvements that you can take out of your capital gains tax. That was some of the earlier slides, so just to fill you in.
So Luke, would that be just simple, like I want the home for 200 and I improved it for 50?
Correct.
That'd be okay.
With closing, yes, and my closing cost, purchasing and selling, that all counted to $250, so I didn't really pay much.
Okay.
Right.
Yes. In this example.
So that includes what you paid for it, the improvements that you made, and you could have bought this
And
home
closing
30 years
costs.
ago.
Yes, ma'am.
Okay, so would an appraisal at 30 years ago be?
No, you need your, purchase documents and then, closing costs and then any, receipts for the improvements. Yes, ma'am. To write that down.
Okay, the 500,
Yes. In this case,
I'm confused between the basis and the principal.
yes.
The 250 and the 500.
The 500 is the primary residence exclusion. So that's just your freebie for it being my primary home. This
I
is my
see.
primary home that Michelle sold.
Got
for me.
it, okay.
Be-
Because you
because
are
you're
couple,
married.
so you get the
Because I'm
whole
married,
500.
yes, sir.
Right.
That's right, because I'm married, I get the whole $500,000 primary residence exclusion. So in this case, we're just gonna assume 6% is the cost of sale. We all know maybe there's taxes and stuff, but for our purposes, let's say 6%. $190,000 is the taxable gain, right?
Can I, so the 250 came from the house that was purchased
When I
20
purchased
years
it,
ago?
it could have
So,
been.
so how do you prove that? You don't have the paperwork anymore?
Yeah.
Reach out to your
Yeah.
title.
You can get the title, documents.
It's just the sale of the price plus.
Yes.
the sale
When
of
you
the
bought
price.
it.
Like your husband.
When they bought the home,
When you bought it.
What if you don't, they don't keep it anymore?
yeah, what if
It's
they're?
like 20, 30 years, who keeps
Make
those
it up.
things, right?
Our
And then if
guys-
you get audited-
Well, you, exceptional, yeah.
Documents when you purchase the house?
No, I know.
A lot of clients do not, if it's like 20, 30, 40 years.
It's
No,
true.
they don't.
We talk to a lot of people who don't have any idea
How
where
far
their
do y'all keep
documents
those
are.
things?
And
In
guess
our
what?
case.
The millennials aren't gonna keep it either.
You're
I think we
exactly
probably
right.
have some of the longest. I
Sarah
don't know
does.
Or
exactly
the
how it
spouse
is.
that died.
Well, she's not gonna be able to find it,
everything, And the
right?
other spouse has no idea where it is.
That's right.
I just don't know.
That's tough.
That's right.
That's a
We
tough
do
one.
the
My
tax
wife died.
records and.
Yeah.
Well, this is,
That's-
20,
that's
30 years
public.
ago is one thing, but how often do people really stay in houses these days,
Well, a lot of elders, they stay in the
That's
house
right.
for a long time. I have a couple that stayed since they bought in 1965.
Wow. Well, their
When-
basis
when-
is gonna be about this big. Yeah, they're
But
not
they
gonna get
can't
much
prove
basis.
it.
Oh,
They
do.
don't have the paperwork to
Hmm,
prove.
That's
We'll
interesting.
tell
Pass
them,
it
sell
on
it,
to
we'll
their
sell them,
heir.
I am not sure about that, Vaughn, but I
Reverse split.
guarantee your CPA can figure out where to get that information.
Would it, because it could be in the tax records, you know, Collin County did
Yeah,
that.
that's
That's
true.
just the mortgage.
Yeah,
Sure.
most of
So
it,
you might be
or
able to
on
find
deed.
a
that.
good
there's
CPA
time.
will find in the tax records and then add stuff that's regular, so it doesn't get.
They'll ask you
Or
for
the
the
MLS,
docs.
if they bought through the MLS, it'll hopefully be there.
So-
2 years later.
MLS don't give you records, just 20, 30, 50 years.
Some do, not all of them, but some,
Depends on the deed.
yeah.
Like the
okay.
sales price and
Yeah.
stuff. We can only go
But
back
not-
5 or 7 years.
That's
On
what I
the
would like,
MLS?
Yeah.
George, for everything. Like,
Yeah.
George, help me.
But
I would call George.
Not all of them.
Yeah, that's what I would do, is I call.
Call
George.
me and I'll talk to one of our
Last point
underwriter
though, what
folks.
is, could you just obviously make it up again, put down an approximate, and then if you get audited, you get audited, then you gotta go find it.
I mean, that's a CPA question, but yes,
Yeah,
that's
I
probably
mean,
what you
that's
do.
what you gotta do if you got a 90-year-old person.
The reason I use this example, guys, is because of the price point there. Now, the basis, you know, the cost, it may have cost me $500,000 for the property. In this case, in that case, I don't have any taxable gain, right? But I'm just giving you this example because once we start to get to that high, you know, 6-figure, low 7-figure and above, your clients, even with the primary residence exclusion, may have to worry about a capital gain. So just to give you an idea.
But the percentage of capital gains also depends on the tax bracket,
It does,
right?
yes, ma'am.
So this is just an example,
This is just an example.
Got it.
Yep, so you can
Okay.
understand how it actually works.
because $1 million, I mean, if their property is that much,
Yeah.
they're probably in the highest tax bracket, which is 20%, right?
I don't know about that. I mean, I see it all
Let
different
the
ways.
hot market.
Yeah, it just depends. It just depends.
Mm.
But, you know, my point being, if they bought it just a couple years ago at 600,000, the good news is for y'all, you can tell your client, you're probably not gonna have any kind of gain on this, gains tax on it. You're gonna have a big gain, but no gains tax.
If they're married.
If they are married,
And
yes,
you can
sir.
do this
I'm
It's
sorry to
important.
keep saying it, but.
Yeah.
No, it's
My
important.
single
Yeah.
gal is.
You can do it every 2 years.
Every 2 years,
Okay.
unlimited.
You can, I'm sorry, you can do what every 2 years?
You can
Sell.
claim this
Sell.
primary, that 500,000 primary
This part.
residence
Every other
exclusion.
year.
And you do not have to put it in another property, you can just put that $500,000 right in your pocket tax free.
And then you're essentially.
Go buy another.
Or, are you like?
I have a-
That's when you sell.
Oh.
You realize the capital gain when you sell, yes, ma'am. Mhm. Yep. So basically, if you're sitting down with your customer at $1 million home, you can let them know, look, you've made a lot of money on it, why don't we sell, and I've got this other property available, you know, in this beautiful neighborhood, you're not gonna pay any taxes, so, you know, now's the time, let's realize that gain. I've got this information for you guys, this is basically a flyer in your packet, and this details everything we talked about on the primary residence exclusion. And, you know, if you want your information on something like this, just let me know, I'll be happy to help you out with that.
So we should move every 2 years.
Basically, that's the incentive why people, it's okay to move every 2 years, because there's no taxes in
Amen.
most cases.
Yeah.
We like that.
I love it.
We love it, we love it. So let's talk about when we're renting the property first and we move in, because when it's a rental first, the situation changes a little bit. And if you rent out the property before you live in it as your primary home, you do have to perform a calculation. So in this case, let's say that we bought the property in January of 2011. Jerry helped me purchase this rental home in 2011. I rented it for 8 years, and we're talking about a 10-year period, so that 8 years is 80% of the ownership period. In 2019, my wife and I, we decided, you know what, we're gonna move in there because the schools are really good in that area. We stay there for a couple years, so that's 20% of that 10-year ownership period. And then I give Jerry a call and I say, Jerry, I wanna sell this thing because the market's gone up so much, and I can exclude 20% of the gain in this case because I was there for 20% of that ownership period.
So 10% per year?
No, it's just, well, I mean, it
Because
works
it
out
says
that way because
2-year
the math.
residence and then 20%.
Percentage of the total.
The 10, 2 out of 10, 10 years. 2 years out of 10
Okay,
years.
so what if you moved in it for 2 years, then it's just a regular?
Not if you rented it first, unfortunately. You can't
Really,
get
that
the
doesn't
full-
go away.
Yeah, it doesn't go
What
away.
if they refinance? If they refinance and put it in their name and everything,
If
after
they
the
would-
8 years, and then 2 years later, they want to,
Unfortunately, if you've rented it before, you still can't take the full exclusion. Yeah,
So,
So what if you stay for 4 years? So is it 40% of ownership?
that's
then?
right. If you did 6 and
Ah,
4.
So that's what I'm about to say, 10% per year.
Yeah, so if you
Got it.
I think if you were to stay like 10 years, you're probably gonna be at 100% again.
Got it.
You know,
back to what we just talked about.
just on the math, so.
Gotcha.
Let's say that, like I say, I called Jerry, you know, I said, Jerry, I wanna sell it for $500,000. Jerry's like, I got this, you know, he puts a great marketing plan together, negotiates the heck out of it. I get $600,000 from those multiple offers, you know? Now, I didn't pay much for this property, $100,000 when Jerry picked it up for me. So he's my guy, and I got, a $500,000 capital gain now. Cause my purchase price, closing costs, and improvements to the property were only $100K. This is a pretty extreme example, right, of me making a bunch of money.
But this is principal residence you're talking about, right?
No, this is the same, this is the rental,
Oh,
converting to
rental,
principal,
okay.
yes ma'am.
Got it.
So we have the $500,000 capital gain, we
We
have
can only
the,
take 20% of that.
that's right.
Gotcha.
So I can exclude 100 instead of the full 500 married, if I'm married, or 250 if I'm single, right? So that's a $400,000 taxable gain, and then the capital gains tax at 15% on that is $60,000. That's a pretty low, in this example, guys, it's a pretty low basis at 100,000, so it's kind of maybe an extreme example, but I've held the property for a long time, I guess, you know? Now,
Is this a new tax law?
we are gonna go into some of the new stuff, yeah, as well. This is basically from 2020. Like when all, this is, but I have some new stuff at the end, yeah.
Okay, but did it change in 2020?
This is all still relevant. No, some of this stuff has changed over the years, but this is basically the current, with a couple of additions I have at the end.
I was thinking that if you get 100% of turning it over to primary residence, then it's still back to primary residence.
Here it
All the
goes.
benefits of that.
That's what he's talking about.
Only if you've been there for
2 of the last 5 years.
enough, not if it was a rental before. Like if it was 2 of the last 5 years, it was a rental before, you don't get the full exclusion. Now, let me talk to you about another example, because this is more like what you're talking about, Jerry, right here.
Okay.
And this is the more common scenario for us, right? I buy the property and I live there for 8 years, and then I say, you know, just like Jerry is, I'm gonna go ahead and move to a new home, I'm gonna build a new home, and I'm gonna rent this property out, let's say. So if I'm in it as my primary first, and then I rent it out, as long as it's 2 of the last 5 years, that's kind of where that rule comes
Okay.
in, not on the other. So that's why I brought that in. So on this particular example, even if I purchase it, I live there 8 years, and then I rent it out for 2 or 3 years even, would be the maximum. And I call you to sell it, Jerry, then I can get the full exclusion at that point. Does that make sense? I know it's a little tricky, but if they rent it, that's the reason I'm telling you guys this, because if they rented it before, it should kind of throw up that red flag in your head. Like, oops, this could cause you to
So
have
it's
some
better
tax
to rent it,
liability.
to rent it after it's been a primary.
It is, for
Okay.
tax purposes.
So what I'm waiting for is when we get to this place where I can tell my clients, okay, you can sell all 3 of your rental properties, buy your dream house, rent it out
Yeah, baby.
for 3 years, and then move into.
We are getting it, yeah. Absolutely, we're getting to some of that. And then move into it, you said?
Yeah, yeah, so you can, when it's changed, you're buying your little McMansion,
Ooh, that's good, I
all
like
money,
that.
and then you live in it or rent it out for a few years, and then you move into
And as
it.
long as they stay, if they just sell it right away, they're gonna get hit.
Yeah.
I like it, that's good stuff. We're gonna get into some of that stuff here in a minute.
But you're not a CPA.
What's that?
But you're not a CPA.
You're not a CPA?
No.
No, he just has a good understanding of it, that's great. And this is what we're talking about, being able to talk to our clients in the different situations and know like, ooh,
Generalities.
you should talk to a CPA.
Yeah, yeah.
You know, like, oh yeah, you probably do wanna talk to your CPA. So in this case, unfortunately,
At least you can put the ideas in their head.
Yeah.
Well, I do.
Here's what to talk to the CPA about.
yes,
That's a good thing.
what we're primarily doing today is hopefully not putting bad ideas. You know, we're getting up when we're not.
Can I ask a quick, because this is making me think of my parents who
Yeah.
had a rental property. They've had this rental property for probably 25 years. It's on this next street over from them.
Oh, okay.
They've never lived in it, ever.
Okay.
So as far as,
They would pay a capital
the
gain on it.
estate, it's going to be
Now,
towards that.
Unless
if they
move
give
in
it
for
to
2
you,
years.
yeah. If they give it to their heirs,
So it needs to go to my sister.
let's say it goes to your sister, Michelle, okay? Your parents pass away. We don't want that to happen, obviously, but let's just say they pass away and they give it to your sister. And the property is worth $700,000 at that time, let's just say. Well, when they sell, if your sister sells the property immediately at that year, she would pay no capital gain.
That year.
It's a step up in basis of the value of the property at the time of the death of the giftor.
If she's married,
If she's, what's that?
if she's married, does she get the 500 excluded?
It doesn't
No,
matter
she
because
doesn't
it's
need to
the
be married,
inheritance.
Oh,
no.
you get the whole 700.
Yeah, she would get the whole 700, yes, sir.
Right,
She would, it'd be completely exempt from tax.
gotcha.
Because she gets, the basis is the value when I pass away.
Got it.
So,
Which would be 7.
would be 700K, tax free.
And you have 2 years to sell it, you said.
No, that's only, you have to do it in that year. It's
Oh,
only in
Oh,
your.
we have to sell it that year.
Yes, ma'am, you have to sell it that year.
Yeah,
to avoid
we're
tax.
seeing some of that now, yeah.
But what you were saying again, Julia, one more time?
So-
If I was married, is that what you said?
No, if they get the inheritance and she can sell it for only 1 year to avoid the
1 year,
taxes?
yeah, because the exclusion for primary is 2 years if you're widowed or widower.
Okay, but not for the heir.
Not for the heir, it's just in that year, so if I pass away and I give you my property for 700, you sell it for that year for 700, then.
And it's a year, not a not a
Yeah, I believe it's the full, it'll be a
full
calendar.
calendar year, okay, okay.
Now,
In
what
fact,
if,
talk to your CPA,
what
alright?
if, the husband died and the wife was 80,
Yeah.
sold the house
Mhm.
and doesn't have to pay tax?
Doesn't pay any tax.
Okay, then she uses that money to give to the heirs.
I don't know about that one.
Gift tax. Well, it's called gift tax.
It would be some kind of gift situation, but that's definitely a CPA question. Yeah.
I think you can give like 100,000 or something.
So now we're gonna get into some examples, guys. So unfortunately for us, that is not the end of the story. Wherever there is a capital gains tax that must be paid, there's also a 3.8% net investment income tax.
Oh my God.
Boo, right? It's capital gains tax on the sale of a primary home in excess of the exclusion. A capital gains tax on the sale of a vacation home, capital gains tax on the sale of investment property, but there is a limitation of 250K married filing jointly or 200K filing single, okay? So you can avoid it if you don't have, hit that income limit. Now let's turn our attention to investment property taxation, and we're gonna get into some of the stuff that Jerry was talking about earlier, so. For investment property, there's different rules, okay? And we need to understand a little bit about these 3 things to understand the rules a little better. First of all, we need to understand a little bit about passive and active income. And then we're gonna learn a little bit about depreciation and 1031 exchanges. Jump right in. So first, let's talk about passive income loss rules. Really, we can think of it as 2 buckets, guys. There's a separation between the 2 buckets. The general rule is that you have a loss or an expense from rental real estate. You can only deduct that losses from the passive bucket, okay? Against your passive income. You cannot deduct those expenses from your active income, all right? So active income, I guess you guys probably get that, right? It's your job, your commissions, income from your normal career, okay? There's 2 types of passive income. There is participation in trade or business activities where I'm not the material manager, okay? So let's say, Michelle, you've got an awesome restaurant in Legacy that's doing really well, and you're looking for investors, and you come to me and say, Luke, you know, it's kind of, we do a Shark Tank deal, right? You and I do a Shark Tank deal, and I'm gonna get 10% of the earnings or whatever for my investment.
Oh, so passive, but my name's Juliet.
Oh, Juliet, I'm sorry, what did I
That's
say?
okay.
Michelle is over here, I'm sorry.
It's okay.
Juliet, excuse me.
Shark Tank's not going so far.
Boom, bum, bum, bum.
Don't.
So Juliet, I invest in your restaurant, not Michelle's. And that's passive income. And then the other type of passive income is rental activity unless you qualify as a real estate professional. And I'm gonna caveat this by my CPA disclaimer again. Real estate professional has a lot of meanings, okay? So it really does depend on what your activity is as to whether that's considered passive or not. So definitely, again, my disclaimer, talk to your CPA in that regard. So for our example, right, this last year, I had $10,000 in mortgage interest or expenses on my investment property. I'm just gonna call it mortgage interest for this sake of this example. And during that year, I actually had no rental income. I didn't have any passive income. So I actually am not allowed to take that deduction for the expenses. Not allowed to take it this year, okay? But I can carry it over to future years when I do have some passive income. On the other hand, let's say I have $10,000 in mortgage interest, and that could also be expenses on my rental property, and I have $10,000 in rental coming in. Those two completely offset each other, and I have zero taxes, okay? But it's gotta be passive to passive.
Luke.
Sir?
Let me ask a question.
Yes, Tom.
Could I assume, I have a CPA, and we send him our basic information, he's handling all that for us?
Oh, yeah.
Can I assume that?
Yeah.
Okay.
He is handling all that for you, but you know, if you wanna know how the sausage is made.
I love
you
it,
can
but I
call.
just, yeah, that's a little deep. Which
It is.
It's good though.
We're just kinda scratching a little bit so we all have a good
Great
understanding of
input,
it.
yeah.
Yeah,
I
thank you,
have
sir.
a question about being the real estate professional in that situation.
Yes, ma'am.
I've had a very, very interesting year.
All of us.
Yeah.
A year ago, I did not, okay, we bought 5 investment properties this year,
Wow,
okay? And,
awesome.
so I have no idea what's happening with the taxes. So that question is important to me because
Yeah.
I am a real estate agent.
Now I can tell you this, Juliet.
Juliet, yes, thank you.
I can tell you this, Juliet. Most of the time, that's for developers a lot, I think.
Okay,
Mainly,
okay.
but I'm just gonna caveat that, definitely, you know.
I mean, I'm
talk-
having my taxes done tomorrow, but,
I think if you have like a commercial real estate company and you're operating through that, right? Then you're,
Okay.
but again,
no, this is a family, like.
yeah, it's just you doing your thing.
Yeah. Okay.
It's gonna be different, I think. I'm pretty sure you're not
Okay.
doing stuff. But ask your CPA. Yeah, sure, great question. I like it.
Passive income, tell me, what is considered passive income again? If you're-
Like you're participating in an investment, like a Shark Tank deal, right?
Okay,
Or rental income, if you're not
or,
quote unquote a real estate professional, which kind of like basically the commercial real estate business is usually what that entails. So depreciation, this is another great thing about investment property. We get a tax deduction for the value of our real estate improvements. So that's cool. So there's a few steps we're gonna go through here to kind of show you guys how all this sort of comes together, okay? Step one, let's look at the value of our improvements, our depreciation. So I give Michelle a call. She's able to find me a property out in Greenville, Texas for $300,000. And we're able to get a contract in, get it purchased. I've got a land value on it of 25%, okay, 75,000. So my total value of improvements is 225,000, right? And as we read in the previous slide, the value of improvements is the deduction we can take. So we can take $225,000 deduction on our rental property.
Once,
Great question, Tom. I love where your head's at.
sorry.
You can't take it all at once, no.
No, okay.
No. You actually have to take it over 27 and a half years. That's depreciation.
Again, our CPA should be doing this.
Yes, sir. So
Okay.
$225,000 value over 27 and a half years. For our purposes, we're just
Got it.
gonna say our annual depreciation in this case is $8,182. Now, I do have my little CPA icon or note up there. Basically just because that's not technically how they do it. They look at like month to month with a straight line depreciation. It's a little bit more complicated, but we're dumbing it down today so that we can run through this and we don't need all those numbers. You know what I mean? Like,
Yeah.
this is for us. Yeah, so 8182. That's not bad for a year, right?
No,
$8,200
that's
bucks.
pretty good, yeah.
We'll take it.
And that's just the house. What if you add like a deck for 20,000? You just put that on top of that?
It does, yeah, that you keep on adding those cost improvements. It
But,
just,
but each one is still 27 years out?
yep,
Okay.
yep, yep.
Got it.
So, let's say we have a 5-year holding period with that depreciation. We're gonna take a total depreciation of 40,910 on that holding period. Step 4 now, the basis comes into play a little bit here because the appreciation does kind of affect that. So we've got the 300,000 was my original basis, right? My purchase price minus the depreciation on that. We are gonna have to take the depreciation. Your CPA is gonna pull that out. 259,090 is the adjusted basis. Let's say I call Juliet. Juliet, I want to sell this property for $375. She has a great marketing plan and she crushes it, and we get $450. I'm super happy. 6% is my cost of sale. We know it might be a little different, but that's just an example. We don't have taxes and stuff in there. The adjusted basis. So then the total taxable gain on that is $163,910. Step 6, let's figure out what the capital gain is versus the depreciation recapture. So here's where the depreciation gets a little bit tricky because, the bottom line is that it is a tax deduction when you own the property. However, when you do sell the property, you do have to pay back 25% depreciation recapture tax. So that split, that I think it was 163,910, right, was split into a 40,910 depreciation at the recapture rate and 123,000 on the capital gains tax.
It's always regardless of how long you live or own the property or anything, that depreciation is always.
The depreciation, yes, will be a recapture of whatever you take or should have taken during that holding period. Yes, ma'am. Yes,
So
sir.
that step 6 is only when we sell that investment house?
That's correct.
Only
Yep.
when sold?
Only when sold, that's right.
Okay.
You're basically, that's the math when you actually realize the gain, and then what are we gonna pay from that profit? Yeah.
Got it.
So
Thank you.
yes, sir, absolutely. Let's get to Jerry's point. The beauty of 1031 exchanges. Has anybody done one of these in here?
Sure.
They're fantastic. So this will bring in, Vaughn, what we were talking about on the inheritance earlier, because this 1031 exchange has a lot of options. There are some restrictions on it, of course. It does require us to be pretty organized in our efforts, but let me tell you how it works. So I have an awesome gain on my property, okay? And I contact Jerry, and Jerry's gonna sell my property. So we put the title with George because he's the best, and he always takes care of us, and we get the property sold. So at the time of the sale, when the loan, or what have you, the sale funds, George's team is gonna take the funds from the buyer's funds, okay? And rather than typically what he would do is just wire it to me,
Buyer or seller?
the buyer's funds. George's team is gonna collect the buyer's funds at the closing table.
Oh, yeah, sure, okay.
Yeah, yeah.
And it's gonna fund, and then you have.
It's
your-
gonna fund, and then typically, George would just send me, the seller, the funds, right?
Right.
But in this case, what he's gonna do is he's gonna wire those funds to what's called a qualified intermediary, okay?
Qualified intermediate.
Yes. Yep. He's gonna send them to a qualified intermediary, and they're gonna hold those funds in escrow for me, so that I'm not touching the funds just yet, okay?
George, question, may I?
Yes, sir.
Do you have those, like if I'm working on one and I ask Kelly to set that up for me, will she do that, or do I
So,
need to?
we actually have a 1031 exchange company. It's called IPX 1031. and they handle all that stuff for us, so.
Don't you have
So it's a
classes
third party.
for that
We do,
too?
yeah.
Other thing I was gonna tell you guys, and I'm
We
glad you
haven't done
brought
one of
that
those in a while, we should definitely.
is that George has a really good CE on specifically the 1031 exchange.
Yeah,
So,
we'll do that.
It's a really great one.
But we have to form that before we even start to buy, right?
You are really,
Because you can't just buy and then now you make a gain, you say, oh, let me put that form the
Exactly.
1031 now.
Yeah, you can't say like,
Can't
oh, a
do that,
1031 would be
right?
you are so correct.
Okay.
You're 100% correct. This is something that does have to be considered between you and your client before
That's
we even
right.
make a move. And I'll tell you why on the back half too, because Vaughn, it really becomes important on this back half. Because the intermediary gets the money from George's team, right? Now, within 45 days, I have to identify, and it can be multiple properties, but I need to identify a property that I'm potentially gonna take down.
Right. Question was, and I'm sorry. Go ahead.
No worries, so if they decide I'm gonna do 1031 exchange, you tell the title company as you're doing that, and they'll have some connection for you at least?
Yeah.
I mean, obviously you have.
If you don't already have a 1031 company that you work with, we have ours that we prefer to work with, and we'll just set you up with them.
I
That's the
see.
way to go.
Yeah.
By the way, because they know the process.
And they have.
Gotcha, okay,
Yeah.
so, and then what if you can't find a house within?
Let's talk about that.
Okay.
Yeah.
You're in trouble.
Well, if you wanna do 1031 exchange and special provisions of the contract, you could write requirements of agree that buyer or sellers during 1031 exchange at no additional costs or expenses to buyer or seller.
Should, should.
That's cool.
Cause
Didn't
my
know that.
question was, can the seller not
Do
decide?
special provisions.
And special provision, and then that way the title company will see that and know that's what they're doing.
I would still call them, you know,
Oh, yeah.
I'd call George.
Yeah.
Let's say our seller's out of town, we get a great price, which will offer sells over the weekend, and then they decide to do that. We can make an amendment during the middle of the contract.
I've got an
You
I don't
can make
think
an
that would
amendment.
after the,
Yeah, like a week after, oh, you know what, I can't, yeah, I
the
don't
buyer or
know.
the seller's not gonna say, oh, no, you can't do a 1031 exchange. So then
Yeah.
I just wanna make sure, in the middle of the
Is it
contract.
considered the same as cash to the seller?
It just depends on your offer. So the money in the qualified intermediary account, that escrow account, could pay for the property outright, or it could just go to the fund.
But I mean, would it be considered cash to them in some ways?
If
Does
it's
it require
paying-
the same amount of, time in the mortgage?
Depends if
Is
you're
that-
financing or not. Yeah.
Okay.
Yeah.
Well, say they're not financing.
It is cash.
Okay,
Yes, ma'am, it's a cash offer.
okay.
And just like you said.
Oh, to buy.
It's just
Yeah,
cash
to
in a
buy the
different
next one.
pocket.
Yeah, it's just cash from my representative Jerry's pocket, so that I don't have to pay tax versus cash coming out of my pocket.
Okay, thank you.
Yes,
And there's a-
ma'am.
And there's a small charge for this person, I'm sure, George, you know?
I believe
There would.
there's, yeah,
Some
a
kind of
little
piece,
something.
But there's some
I'm not exactly sure what it is,
benefit
but.
to someone, some way, because they want that money in
Oh,
that
100%.
intermediary time to invest, that's why there's some kind of
Yes,
benefit.
so you need to have a good plan, right? Like, you need to have a good plan, let's say it's like, Vaughn, I'm gonna sell your house, and I've got a bead on a few houses in Greenville, Texas, or Sherman, Texas. I've got 3 or 4 that are available, about to be available, so if you're thinking of selling that one in Frisco, let's go ahead and redeploy those assets in Greenville, and we can identify them within 45 days, and then when we go to close, we just have to close within 6 months. So let's
And
say.
is it only one property, or can you?
Ooh, I love what you think.
Okay,
That's good
can
stuff,
it be
Juliet.
a couple of properties, and
Sure
does
can.
the property have to be more expensive than the one that you just sold?
It's a great question. and I'll
Equal,
address that in the
equal
very
or
next slide.
more,
Pardon?
equal to or more.
Okay.
It can be up to 200%, I believe. So 6 months, we gotta close on the new property. The qualified intermediary then wires the money to George again for the closing on the ones that I'm gonna buy, okay?
But you
So,
can also extend if you can, like for example, if they're buying a new build, and with everything that's going on right now, I've got new build that's delayed 2, 3, 5, 6 months.
yes,
Then what? So you can go back to the
I'm not sure
1031
about
to
that.
say,
It does say you can use it for a new build and identify a new build, but I'm not sure about the closing date, cause it does say in the 1031 you have to close it on. a new
yeah,
date.
but then
Wow.
we have no choice, because the builder can't close.
You're the IRS, you're not.
Because all the supplies are in the boat out there shipped from.
Ah!
It's over
Yes,
to
ma'am.
California.
Yes, ma'am.
You're gonna be on hold
Right,
for
Tom?
6 months.
I'm with you. I just.
Yeah, good
Putting
plan
it
in our
down
market.
and then selling
Yeah.
something
You
later.
gotta have a good plan in our market, Jerry. It's a good point that you guys both are making. You have to have a good plan. If you don't have a good plan, you may get stuck, and then you do have to pay the capital gain after that 6 months.
Yeah, so there you went,
Ah.
selfless.
So just
But-
make them aware that there's a big risk.
Or
Or
I
you
have
can
got
contract.
the special sauce, and then they're not gonna go with anybody else, right?
Alright, go for it.
Yeah, Michelle's like, look, I got this, I've already got it lined up for you, what do you think about this opportunity? Yeah, I'm gonna move my money, and then you get like 4 deals out of it, right? Cause you're the one that put it in.
But don't risk. I mean, if it's a new build, it's gonna be like almost ready.
Yeah, it gotta be a frame.
Basically, it's gonna be ready in
I
5 months, we have
always
6
lay
months,
out
don't
the
do it.
Maybe even drywall.
Even I have one that's like 2 months out. They couldn't get the shower thing, they couldn't get the cabinets, the sink, I mean, and I thought, what the
The whole net
hell
road's waiting
is
on you.
this?
If
Yeah.
you're gonna be paying all cash, then you can take that house and buy it without it being finished.
I didn't know that.
They won't let you.
They won't
Most-
let
They
you.
will, the lender, if you're using a lender, they won't let you buy it.
The builder will not let you close,
Most
the
of
house
the-
will finish.
You have to
I
have
would
a
say
studio
so.
to move in.
Yeah.
I think.
But you
they
can ask.
I think they know, I mean, they're,
It's
you're
maybe
paying
very-
cash,
ask
they'll
anyways.
make an agreement, you know, they'll say, okay, well, this has to be done, this has to be done, we
Mhm.
agree to do
Maybe.
this.
I've done that before.
Oh, yeah?
Yeah.
When
I've
it-
done
when-
it.
when there's
Same.
not
Close
completely
with us
done.
before. Yeah.
Interesting.
Yeah.
You have
So-
an amendment that they have to finish it.
If you want a loan, unless you're doing, some kind of renovation or construction. If you're doing renovation or we're doing custom construction, obviously we don't need a CO, but to fund a conventional, you do.
Yeah, last one. So
Yes,
this
sir.
is all okay, approved with residential homes?
Yes,
Stupid
and that is a
question, but
very good question
I was just
also.
told something different yesterday.
No, you know what, that is
From
a very
CPA.
good question. It is not just residential.
Right, but it can be with residential,
It
right?
can be in residential. This is more.
But then
of
why
a-
did Joe say that,
I wrote it down.
you
But
can't
it's
do
gotta go.
1031 with
Ask them.
residential?
They're in his
Residential to
class. You see
residential,
him next.
commercial to commercial. It can't.
Is that
You
right?
can, because it's told you.
No, you can do whatever you want.
Investment property.
Yeah.
I'm
You
sorry?
can't do it on a house, on a residential house where you live in, it can't be.
Right.
No, this
Say
is
that again?
investment
Property,
property.
investment property.
That's what I'm asking. So it can't be on a house I own,
I'm gonna get to that in just a second.
Not
residential.
The next slide.
That's what-
Almost. Yes, the next slide, the next slide.
So you're talking about, you can do it if it's an investment residential?
Only.
Yes.
Yeah.
I was talking about primary.
As long as it's not your
Oh,
home.
yeah.
It's my house.
I
Like in
got
the
it.
widow lady, right, excuse my language, but the widower that is selling, she can't use a 1031 exchange.
No.
Cause she's been.
I misunderstood. I
Okay.
thought you were talking about investment residential.
That's
Okay.
fine, yeah.
I agree
Okay.
with Joe, because you can't.
Okay, that stinks.
Now, let's say I have a $200,000 capital gain when I sell an investment property, all right? Now typically, I would have, taxes of $37,600 on this type of property, potentially $30,000 in capital gains, $7,600 at the 3.8% net investment income tax. On the other hand, if I simply use a 1031 exchange and roll over the proceeds to another investment, keep in mind that there is no limit, then I don't pay taxes. Keep in mind there is no limit to the number of times I can use the 1031 exchange. I could use this strategy to continuously roll over profits from the sale of real estate without ever paying capital gains tax. Then when my heirs inherit the property, even if those properties are worth $1 million, they receive the step up in basis. That means that they could sell it at that time and not have to pay any capital gains tax either. So for a long-term investment, let's say Benjamin is investing and he's thinking about his kids. Juliet, you're buying all these properties, you're thinking about your kids. You roll it over during your lifetime, you make all this profit through the 1031 exchange and you're getting more and more rental income. Then when you pass away, you give it to your kids, and then basically you've avoided capital gains of your lifetime and for them to take advantage of the profit. So it's pretty amazing stuff. Excuse me. There is no limit to the times you can use the 1031 exchange. When you do the 1031 exchange, as I just said, your heirs still receive the step up in basis for the value of the property at the time of your death. The 1031 exchange is ideal for long-term investors. This is kind of what you guys were talking about, which is also really great. You can use the 1031 exchange to diversify. So I could sell one apartment complex, and I could contact, Tom and say, Tom, I wanna sell my apartments.
Yep. Yep.
Sell this 10-unit for me, this multi-unit, and then, I really like those properties that you showed me out in Millsap, Texas. I know it's a long way out, but that's where the construction's going on. Help me get 5 of those with this apartment money, and we're gonna do the 1031 exchange. Can we do that? Sure,
Yes.
let's get it done,
Yes.
I mean, that's half my year right there,
Yes.
You can use the 1031 exchange to consolidate. So if Michelle had, 10 properties, she could sell all those properties, put, George puts the money, and his team put the money with a qualified intermediary, and then Michelle goes and says, I'm gonna take all that money and I'm gonna buy this, 50 unit, yeah.
Could you buy like 50 acres of land?
Yes, you
But
can use
that,
it
say
for
she
land.
has 5 million of those. and
That's
go
a
buy
heck of a use for it right now.
50 acres, yeah. And sit on it and do what you want with it.
Put a couple of little tiny houses and, rent them out, cover the taxes and.
Sell those off.
Yeah,
Little by
whatever,
little.
yeah, exactly.
And I'm curious to know.
Build some homes, sell them off? Yes, sir.
With the consolidation, does the time frame start whenever you sell that first one and submit to the interview?
That's why I say you gotta be prepared.
Yeah.
6 months?
Yeah.
45 days.
6
45
months.
days to allocate, 6 months to close.
So when you say allocate, I'm sorry.
Identify,
stupid
is what they
question.
call it.
Identify the properties.
I would email George's person at the 1031 IPX and say, okay, Tom and Bob are gonna buy this one. That's all I have to do. That's what you mean by identify?
Identify, you actually have to identify
You'll list several properties.
the property,
Oh,
yes.
Okay, you can list a couple?
Yeah.
Gotcha.
You can do, it depends.
I gotcha. And
There
then-
are
Different rules.
there's a rule book.
And I'm assuming.
We're not going through the full
Lot
rule
of
book
rules.
today.
Your.
There is a rule book.
Yeah, so, but George, your person would help us, right?
Oh, of course.
Okay.
I mean, they are the experts. That's their life
Got
that
it.
surrounds 1031 exchange. I
We
mean,
just,
What's the history of 1031 exchange? Why is it called that?
That's the text code.
It's just the
yeah,
tech-
it's the number tax code and
Oh, okay, so it's not
big book of
1044.
tax law.
Okay.
that's the little loophole, I guess, right? Is what we're dealing with. It's a huge loophole, probably used mainly by the ultra wealthy, because
Yeah, they're always trying to get rid of it.
Yeah, so we wanna be able to use this for our clients in our market
The
now.
government says,
Yeah,
okay.
yeah,
Cause I mean,
Cause it would bring more tax in.
yes.
Okay, gotcha.
cause ultra wealthy people are using this to sell big properties and not pay taxes.
Well,
And that's what we wanna be, right? So-
I was talking with, one of my coworkers who's good friends with the Hunts, the lawyer of the Hunts, and he was explaining to me the multiple, I guess, trusts that they have, and how they'll hold the property in a certain trust level, depreciate it for years, and then sell it off to the next trust who holds it.
Genius.
And it's a huge, I mean, they're skipping taxes for generations.
Yeah, and that's very interesting, Benjamin, because a couple of years ago, I did a loan for a guy who worked at US Trust and the Star, and he and his team managed all of the assets for like the Jones family and some of those guys, and they said like 60 to 70%, depending on what year of their profits, they buy real estate. It's all going into land, and they're doing exactly what you're saying.
Prosper, Salina,
Oh, yeah.
that's where they're on.
So guys, I have a little sheet in your packet that goes over all the stuff we went over today. This particular sheet in your packet has my info on it, but if you want your info on it, you can call me anytime, and I'll be happy to help you with that. So, this is the new tax law, Jerry, that you were talking about. So typically, real estate earnings are taxed at ordinary income rates. But in 2020, they actually changed that, and the IRS has allowed rental real estate income to actually count as pass-through income. So you get 20% deduction on that pass-through income now, which means that we just pay less taxes. There is a ton of tax advantages to owning investment property. If you guys, obviously Juliet, you do, but if you do, most of the time, you don't pay a whole lot of tax, right? It makes it more attractive to invest in real estate because flat out, it's 20% more profit or more. Let's look at this example. It's actually quite a bit more in this example. We have the old tax laws at $10,000 in rental income from real estate. Then we have $10,000 income back then, at the federal tax rate of 28%, you would have paid $2,800. Under the new law, you get the 20% tax deduction, you're down in the 24% range, and now you're only paying $1,920. So just something you can tell your clients, look, the federal government has made it even more profitable to invest in real estate in recent years. So guys, I'm gonna get to the conclusion here, and then I'm gonna drop a couple other things on you real quick. Thank you so much. The tax basis, we figured out today how that works, and I think that's probably opened a few eyes on why it matters for that capital gains tax calculation. We learned how to understand a little bit better and how to use the primary residence exclusion to the capital gain, and then we learned how the 3.8% investment income tax works. We also learned and saw some examples of how the capital gains tax works. We looked at examples of rental income, depreciation, capital gains and losses on investment properties, and we learned a little bit about the 1031 exchange. And I really enjoyed our conversations today, guys. Thank you so much for attending my CE. Woo. I wanna-
5 stars.
Good info.
Thank you so much, Greg. Thank you. Well, a pleasure. Let's have a Q&A here in just a minute, but I wanna tell you about a couple more things here before we wrap up. Number one, it's our certified buyer program. This is a guaranteed 19-day close, where we pay the seller $200 a day. What we do is we remove the financing contingency from your buyer's financing. So we underwrite the file up front, we approve it, and then that allows me to call the listing agent and say, Benjamin, this guy is rock solid. He is much better than a flaky cash offer because he's already done the work. We already have him fully approved for the loan. We're just pending appraisal and title. And by the way, we're gonna do an appraisal waiver, so don't worry about it. You know, really, we just need the
Are
title.
you a direct lender or a broker?
We are direct.
Is that
We
this
also
one?
do broker, but most of our lending is direct.
Is that this one?
That one, yes, that's the one.
Okay,
So if y'all want more information, I got tons of information about that.
cool.
We offer a 6-month lock policy. Remember I was telling you guys I'm
Is
part
that
of
in
it?
our package?
What's that, ma'am?
6-month
On this
policy.
house?
It's-
Yes,
it's-
ma'am,
it's-
it is. We offer a 6-month, a long-term lock, extended lock
See it
package
in
right now.
here.
6 months.
On the-
No charge.
Towards the back.
Yes, ma'am, towards the back, there's a couple, yeah, thanks, Michelle. So 6 months, remember I told you I'm with the builder group, we do a lot of new home construction. When they're at frame bond and they've got 4 months, we hope, 4 or 5 months left, we can lock in for 4, 5, 6 months, whatever the customer wants. And we offer a free float down within 30 days of close. So basically, they're protected either way. So we lock them today. If the rates drop, we drop it before they close. There's no loss. It's a great program. We also have,
Any extra rates or fees for that?
there is not any extra, fee for that. There's a tiny little bit on the rate from today's pricing, but that's because we're doing a 6-month contract.
Right. Are they
Now-
still about 3.7 right now?
Yeah,
Depends on the buyer.
depends on the buyer, but yeah, down in the
It
mid
depends on
threes.
your credit score.
Right.
I'm just,
Down in the mid,
obviously,
mid
just average.
375.
Yeah.
But that being the case, everybody's worried about rates. We also have our rate protection plan on our files. So if they close on the loan in 36 months, if the rate goes down, then we'll do a streamlined refi for them if it goes down half a point or more. No appraisal, no fees, and we will just set up a mobile closing with George.
No
Wow.
additional fees to change it to a rebuy.
There would be some title fees, you know, but no lender fees. Yeah, but George is gonna give you a huge discount on those as well, so. Now,
Thanks,
yeah, you know, because you just bought a couple of years ago. So home bought, this is actually a digest that I send to my customers once a week. And if you guys have a Bank of America app or Chase or something, this is basically like that. They are checking their home's value and also a lot of other great information very, very regularly on this thing. This thing is my listing generation, lead generation magic tool.
What are the numbers coming from?
I'll show you. I love you guys' questions today. Y'all are all over
So we
this.
can send this link to it with our face on it?
What's that?
Is that what you're saying, it's an app and our face is on it? Like
It
your
is,
face
let me show you, let me show you. I generated 4 listing appointments for my referral partners last week from this. Basically, because this thing does all the work for me. On Monday morning, I get an email, it tells me who is going in there and checking what. Like, let's say I go to my bank app and I look at my checking balance. I get an email saying, Benjamin went in there and looked at his checking balance. And then he did a calculation because he wanted a credit card. So it